Hey everybody, this is Richard Whalen, owner and broker of the Imagination Brokerage. I am absolutely thrilled to be with my preferred residential loan broker here, Mr. Jonathan Williamson. Jonathan, thank you so much for joining us today.
Thank you for having me, Richard. It's so nice to meet you in person.
We originally met through one of my clients and good friends a couple years ago.
Yeah.
And, he was really singing your praises. Like, you guys grew up together.
We did.
And, and he said, you want to work with you. And it just totally blew me away. Absolutely blew me away.
Thank you. And likewise, your attention to detail and, everything you do for your clients is huge. So, it's very nice to be here.
Thank you so much. Yeah, you're just about the most responsive loan broker I think I've ever met. I mean, like if I text you at like 9 p.m. on a Saturday and say, hey, our clients just decided that, we saw something this afternoon in open house, they love it. Like, can you write an approval letter? Like it by 9:30. that letter is like fully done, ready. It's in our mailbox. I don't know how you do it. You're amazing.
Thank you. It's just, part of the job. I love what I do. Well, mortgage wise, I've been in it since January 2021.
Mm-hmm.
So I got in right when COVID was hitting, and then everything was
so you
getting
got in
crazy.
just as interest rates skyrocketed and everything just completely went to hell.
I had about 1 year, January 21, rates were still nice and low.
Yeah.
So I actually had a friend of a family member recommend a mortgage to me. I always thought, some kind of real estate would be a career path that I go into. And COVID presented that time in COVID when everyone was furloughed and, had that time to dip my toes into getting licensed as a mortgage loan officer. So,
awesome.
That is how I got into it. I was recommended it. Mortgage and real estate, they work hand in hand, but they are two different things. I love the numbers. I love finding ways to make the loans work.
Sure.
As opposed to maybe on the real estate side, like actually going out showing the houses, like just like you showed me here, this building, and pointed out all the details. Like you're very detailed on the type of properties and like what they can see there.
Sure.
And then I feel more like I can hone in on the numbers and ways to do that. So first year in mortgage, rates were still low. I did about 90% refinance, just because that's what the business was at that time.
Sure, yeah.
As I learned my way, and then as rates started to go up, switched over to about 90% purchase business, 10% refinance, and then now that rates have kind of leveled out, now we're seeing a good mix of both.
Okay. All right, gotcha.
Yeah,
all right,
but mortgages is great. Best part of my job is being able to help families find their home and make that dream a possibility. So,
sure.
That's huge. Best job I've ever worked, hardest job I've ever worked, but also the best job I've ever worked. So a little over 5 years now doing that. And, one thing that, the broker that hired me first said was, he's been in it 20 plus years, and he said, still to this day, you're going to be learning something every day.
Sure.
You are always learning. Programs are always changing. Rates are always changing. The market's always changing. So that's one thing that just keeps the job, interesting and, fulfilling is, you always have something to work on and learn.
Yes, the mortgage business has changed so much over the last few years. Different products being offered, different just different challenges as people have been grappling with this post-COVID world.
Yes.
I mean, talk to me about like kind of some of those, like basically, what was your initial reaction when the interest rate suddenly skyrocketed? And then, like exactly how did you feel like you were able to kind of pivot and figure out kind of, where to take your business from there?
Yeah, that's a, great question. And it's, as they went up, I think it was always expected that they were going to go back up. We knew that they were, artificially low for the time, which was fine. And it presented a lot of opportunity for people. But actually at the time, the idea was that, as rates would go up, potentially home prices would level off or steady. A lot of clients that I helped during that time, they're bidding massive amounts over asking and going up against 30 offers. So the thought process from there was, yes, as rates go up, does make affordability tighter especially for first time buyers or people starting out. But it also presented an opportunity where, okay, maybe this market can kind of calm down a little bit and kind of go back to normal, where people have time to do their due diligence, and find that right house, as opposed to just going, hey, this is the one that looks like it fits the ticket and we're just going to dive in because we have to. There's 30 other offers. So there was that on the positive side too. And it actually took a lot longer to kind of get to that point, a couple of years to actually go back to that. And we still see it now, even today, where just depending on the property, how it's presented, with all the extra details, just like you do with your listings, like just those type of listings still get, a lot of attention, multiple offers. So that was kind of the pivot though, at that time is, there is opportunity there. And, so, pros and cons with everything.
Sure. Yeah, no, I mean, I remember like, for like the first year, maybe even 2 years, it did seem like it was like no one really knew what was going on and everything kind of ground to a halt.
Yeah.
But it's one of those, and I remember hearing from people about the Great Recession as well, that, if you stick through it, then, because so many people dropped off.
Oh my goodness, yeah.
I think it was something like within the first year, 70,000 real estate agents in North America left the business.
Same on mortgage. The amount of renewals for mortgage license, I don't remember the exact number percentage, but it was massive after that time, which it is hard. It is hard for a lot of people to continue that business. If they're you got to work hard. That's in anything in life, any industry, any business. You got to work hard and put the time in, but also have good team and good partners to kind of make it through. So there was a massive change there, which also for the people that stuck it out, have more share there and more opportunity too.
Sure. So just the past couple of years have been interesting. I mean, they're much more busy, thankfully.
Yeah.
But we went through, like, last summer was the slowest selling season in over a decade. Like, since 2015, we haven't had houses sitting on the market for that long. Okay. Then back in February or March, they dropped the interest rates about 0.5%.
Yeah.
It felt like things were kind of picking back up. And then I don't know if they were picking back up too fast or something, because then all of a sudden the government, slammed on the brakes and went up 0.5% again.
Yes.
So, I just kind of wanted to talk a little bit about, just like, let's say in the past 6 months to a year, any sort of like new, unique, I guess maybe challenges or anything that you've been dealing with, any particularly tricky, clients that you've had.
Sure. Yeah. I think the main thing that I've seen too is, a lot of people are understanding that, interest rates don't necessarily drive their ability to buy the home. Everyone in life has a different scenario where maybe they're outgrowing a small house, maybe they're downsizing and, kind of trying to time the market. Some people have waited and then found that, either the situation stays the same or gets a little worse, a tiny little bit better. So, what I've seen, I've helped a lot of pre-approvals throughout the year. Some go through right away, some wait on it. And what I did notice is, a lot of people started dipping their toe back in the market and just, I think they're understanding that this is kind of where it's at right now. And, the variance, even with rates going up and down, as far as from a payment standpoint, it can be big, but most of the time it's only then a couple $100, and most people find a way to budget for that. So people that have been waiting are now finding that, hey, we waited a long time. I think we're ready either way. And when the market comes to us, rates go down, there's always the ability to refinance. That's why it's great having a good loan officer that can kind of advise you on that, and not only just help out with the purchase, but in the long term say, hey, the market is here, whatever it is, the government has done this to help lower rates, or wartime's over right now, rates are coming back down, it's time to refinance. So that's kind of what I'm seeing. People that have waited, that had the ability to buy maybe last year or even the year before, and they're kind of waiting around, just life situation kind of dictates, they can go. So what I've always advised is, obviously make a budget, not just for your mortgage payment, but for everything. That's huge. Knowing your numbers, putting it down on paper, a spreadsheet, whatever you're comfortable with, and making sure that it works for you and your family. It's always that step up to get into homeownership or to that bigger house. But just knowing in the long term that there are ways to save too, I think is, real nice. So,
one of the things I try to communicate to people is, especially if they're trying to make the leap from renting to owning, is that, owning almost anything in the long run is financially going to be better than renting almost anything. And that's true for almost every living situation, there's only two, like if these are your number one priorities, there are only two aspects that I'll say, will override that. And that is if your career is really reliant on geography, and there's just no way that you can afford to, continue living there for to own there in wherever that is.
Sure.
So, that's true for a lot of people that work in Hollywood, for instance, or, other parts of the country, like people have, big financial jobs in downtowns or big tech jobs downtown.
Yeah.
And then the other one being school districts, like sometimes if you, if you can rent in a better school district than you can buy, then, that may make a lot of sense for you if your kids are public schooled for as long as they're in school. But aside from those two circumstances, like from a purely financial perspective, it's a no-brainer, that, like, I know that it feels, to somebody who's coming from a renting perspective, it feels like they are spending more money, maybe twice as much money, right? So like on average, like a rent of $3,000 is like equivalent to like a mortgage of like $5,000 a month
well
for
said.
a lot of markets, right? And at least for most of our millennial buyers, like the price ranges that they're shopping in. And, but the big thing is, what I'm always trying to communicate is that it's a difference between giving someone else $3,000 versus taking $5,000 and putting into a savings account.
Yeah. No kidding. Yeah. It is like that.
It pays you back. It's like taking money out of one pocket and putting it back in another pocket. Yeah. So it's like, yes, on the one hand, saying goodbye to that $5,000 a month for a bit is troubling, right? Yeah. Like it puts a lot of stress on you. But honestly, once you've been through it once or twice, and people who are, Gen X and baby boomers know this very well, right? Once you've been through it a few times, you start to realize, oh, wait a second, like mortgages aren't that bad at all. They're not that scary at all, Yeah.
Especially when you see that equity start to climb and your future self appreciates it for sure.
It's addictive. I know, like people who check their Zillow or Redfin all the time just to see how high or how low their equity's gotten, And
they'll remind you, you could set up those notifications and you get that email once a week. Oh, it went up 1K. Okay, great. Oh, down 1K. Okay. So,
people love that feeling, because it feels like rooting for a winning team.
For sure.
So it's very good. And so, I try to, so this is what I do. Like my job, I find, is to first get them excited about the idea of buying a house, right?
Yeah.
And then I immediately put them in touch with you.
You do.
To just start coming up with that further conversation of like, all right, well, now how do we get from here to there, right?
Yes.
How do we plan it out? How do we save? How do we budget? What do we need to know about that we didn't know about that, maybe could be a more creative option. Yep. A few minutes ago, you were telling me off camera about the basically how, it's so complicated because county by county, there are different buyer's incentive programs, different down payment assistance programs, et cetera, et cetera. Can you tell me about like a situation, let's say in the past year, where someone who essentially thought that they would never be able to buy a house, where they came to you and had the conversation, suddenly they were like, oh wow, like that's actually doable.
Absolutely. Yeah. And we'll touch on that too. And I think a lot of it too is there's so much information out there. You can Google, you can click, but really once you do introduce me someone, my job is to try to get them the real information exactly to their qualifications, because there is so many different programs and ways to qualify for a home. So, that's important to me, even if it's, not a fun conversation, if it's above what they're expecting. it's always good to know, what you're getting into, and then, like you mentioned, how to budget. But man, so many times, especially with first-time buyers, or investors too, that's another avenue, and we can touch on that too. But for like first-time buyers, where so many people are making more money than they've ever made, in their careers, with everything rising in cost too at the same time. But the hardest part, a lot of people have good credit, they have that under control, a good paying job, maybe two salaries in the household, but the savings is low. So that's usually what I see the biggest barrier to entry is that savings. A lot of people can budget for that extra payment, like we talked about earlier, that jump up in home ownership pricing. But yeah, having that savings is huge. So many times, not just one client, but many clients, either we will dip our toe into homeownership and do the minimum down, which you could do minimum 3% down or 3.5% down. I always advise, if you have the ability to come up with your down payment, that will set you up in the long term the best way. If you don't, there are down payment assistance programs, all the states, but here in California, it seems like there's a few extra. So if that is truly, hey, we need to keep whatever cash we have in our bank for when we move in, maybe we have repairs to do, or we just need that safety net, they can go with down payment assistance too, which is a great option. So that's a case that I run into all the time, where making good money, credit's there, we can stomach that payment, but between your down payment and closing costs, how do we do that? That's something that I love to get creative with, and try to find that solution. Your trade-off is typically a little bit higher payment than if you were to not do down payment assistance, depending on the program. But that's a big one. So
sure. It's one of those things though, where so one of the things that I run into in my phase of the conversation is a lot of people tend to overestimate how much they need to have saved up.
Yeah,
absolutely. I think a friend of mine was kind of talking about how, when he was doing research, and by the way, millennials are excellent at doing Google research.
Yes.
But not generally as good at just picking up the phone and just talking to somebody.
Yeah.
Yeah. And so you go on Reddit or whatever, and everyone's like, oh well, you don't want to have to pay mortgage insurance. You gotta save up 20%, et cetera, which is perfectly good advice in the rest of the country.
Sure.
But in California, where that's, on average going to be at least $200,000 in savings, realistically, the vast majority of people don't have that.
Right.
And, guess what? There are plenty of options for people that don't have that amount of money saved up, know?
And I think what a lot of people find too is the payment difference between, let's say, okay, we have our 5% or 10%, let's say we're talking 20%, and okay, maybe we need to wait a year or two more to get to that 20%. Once you actually run the numbers, sometimes you find the payment difference isn't that massive of a difference, where you're like, wow, it's not actually that big of a difference. So once again, that's where finding out what your actual payment is so important, so you can budget and then decide if it's time to wait. Biggest thing too, I always advise is credit is a huge part of mortgage insurance. So while if you do put less than 20% down, you'll have mortgage insurance, or if you go with an FHA loan, you'll always have mortgage insurance, or at least for the first 10 years, depending on your down payment. Credit score is a huge part of that. So if you are keeping your payments on time, keeping your balances low, that's going to help. Mortgage insurance can vary greatly depending on your score. So that's another thing that can help too. And you might find, wow, it's actually not that bad. Get you in there, and then as your equity grows, and depending on where the market is, that refinance down the line also helps chip away at that. So you get closer to that golden 80% loan to value, or 20% down. So,
right. Yeah. Well, yeah. Not to mention that when you refinance later, you can, factor in any increases in value of the property.
Yes.
You know what I mean?
Yep.
So like, while you may not have been able to save up a whole 20% down, if your, property goes up 10% in value and you already put down a 10% down payment, whatever, you could potentially refinance at the 80% down mark. And then, or loan to value market, you would call it that point. And then boom, like the mortgage insurance goes away.
Yep.
You have the best of both worlds in terms of like the rate that you're paying and like the amount that you're paying each month. And on top of all that, you didn't have to put any extra money in order to hit that number.
That's right. Yeah.
So, and by the way, in California, where the home values go up on average about 6 to 7% a year. I mean, that means that in just 2 years, if you do nothing,
no kidding,
you can go in and refinance, and odds are you're going to be able to add another 10% at least of equity to the house, and boom, fix all those loan payments.
Incredible with California, it's just it's a beautiful state, and it's just a bonus there for sure.
Now, I wanted to also kind of talk a little bit about you mentioned that you've done a few other things sort of beyond like the typical, residential, first time home buyer thing. I was wondering if you could kind of like walk me through, just some of the full range of products that you've worked on,
You got it. Yeah. So once you're kind of past that first time buyer stage, a lot of people looking either to buy an investment property, or just different ways, just to try to grow their long-term wealth is really what it is. But when it comes down to investment, the main thing when you're going into investment property is having a good down payment. Credit and down payment is the main two things, where you can get into an investment property with some good programs. So you can always go your standard conventional way. Qualify where a lender's going to look at your income, everything from credit, all those things. So but if you have a good down payment, a good cash flowing property, there are programs that you can get into the investment market with simply just your down payment. What is that home renting, or what is that property renting for? What is the cash flow? And then there's programs called like a DSCR is very popular. Debt service coverage ratio is what that stands for. So all that means is it's just, does the projected rental payments or current rental payments cover your mortgage payment, and what's that ratio? And then depending on what that ratio is, different pricing is available. So that's a huge way to get in, especially if someone's already owns a home or a property or two, or if they're self-employed. And like all self-employed, people take write-offs as they should. But sometimes for a lender, they want to see, with mortgages, they want to see your net income plus some of those write-offs back. So that's where like a program like a DSCR is huge, just to get you in. And then really, once again, the credit's a big part of that. So that's
which once again, it's because like with a normal loan, with a conventional loan, they're trying to see what can you afford with the income from your job. But with a DSCR loan, it's like a paradigm shift where it's like, can the property afford to pay for itself?
Yeah.
If so,
absolutely.
Then they go ahead and give it to you. And if you don't have, potentially, depending on how much money it is,
right,
you don't even have to have any money down, really. Or you have a little bit, but sure, there's a lot of different things out there where if they see a good investment opportunity, then they'll go for it.
Right. Yeah, and that's the gym, and that's where we're working with a great realtor like yourself, like being able to find that, because there's a lot of opportunity out there, and being able to weed through the right properties to find that sweet cash flow. And that's always the goal, right? Long term, it may not be from the start where you get the full coverage from rental to covering your monthly net, but that's always the goal, having the rents pay for the mortgage, and then in the long term get that thing paid off.
As well as, there are a lot of situations recently that I've seen where millennials who maybe didn't quite have enough income or didn't have enough savings, right? They go in and they actually buy a multifamily property,
Yes,
right? 2 to 4 units, where you can actually factor in some of the income from the other units
absolutely.
to help cover your expenses. I was wondering if you could chat a little bit more about
yeah,
that. Yeah.
I've done quite a few like that, where if you're okay with a shared wall, or yeah, many first-time buyers themselves, you can do this with an FHA loan, which is huge. So you could put 3.5% down. FHA allows for a higher debt-to-income ratio. So meaning that, with your mortgage payment, and if you have credit cards or things like that, car payment, which, we all do, it's much easier to qualify, because you can use your rental unit. It's a duplex, or your rental units, if it goes up to 4 units, 4 units is the max, to help qualify. Just huge. And then in the long term, that just sets you up even better. So sure. Great tool.
And a lot of people don't realize that you can actually do something very similar with VA loans.
Yeah,
VA loans also very low down payment, low rates.
Yes.
So one of the things I always tell my friends who are both in the military and veterans is, if you're not using that VA loan on multifamily properties, you are leaving money on the table. Yeah. That is such an incredible way to get extra income, especially if you're still in the military. Maybe you have to travel a lot, you have to move a lot, right?
Situation changes,
and that's a reason why a lot of them decide not to buy. They only rent. But no, they're looking at it the wrong way. If you bought a house everywhere you're stationed and just rent out every room to soldiers,
there you go,
right?
Yeah.
And then when you move, you just refinance that house with a DSCR loan, because now it's cash flowing, right?
Yep.
And then use your VA loan again to buy something else in the new city, right? Yeah. By the time you retire from the military, you've got a whole portfolio of properties helping you out.
Yeah. And the VA loan, I always say it's the absolute best loan you can get in the States, and it's well deserved. And for a good reason.
Exactly. Wonderful. All right. I wanted to talk to you also about basically some of the, I guess you would call them unintuitive things about the loan process, like the things that kind of end up surprising people as they kind of start out this process. One of the things that I'll point out, for instance, is, because I think because people have generally a very general sense, save more money, pay off debt, save more money, pay off debt, right? But the thing is that they don't always know, they don't realize that the banks see all the income differently. They see all the savings differently. They see every different type of debt differently, right? There's people out there. I know there's someone out there right now. Hopefully I'm able to catch the one person who's watching this right now, who thinks that they should be focusing on paying off their car because their car is the most, the biggest debt they have, and then in doing so they're ignoring their credit card payments. You know what I mean?
Or in the sense, very, very, to touch on that with car payment too, most of the time on cars the rate is pretty low, or if they've been in the loan a long time, it's amortized, so they're paying more to principal, and that they've already kind of paid that up front, doesn't affect the outcome as much as they would think they would. So that's definitely something that comes up quite a bit, where it can be a good tool, depending on how high their car payment is. If your car payment is close to $1,000, that's sometime, and your balance is fairly low, getting that to 10 payments or less, or paying that off could be a benefit. But most of the time it's not a big of adjustment, or something that necessarily a lender would require or need to get to that next step.
Sure. You hear the horror stories about people who signed up for a new credit card at exactly the wrong time, and now their credit's a little bit impacted, and they lose out on their home loan, right? People who bought a car at exactly the wrong time, and now those payments are taken out of their debt to income ratio, and maybe that's that extra house,
or they're looking and they need 100,000 more in approval, and maybe that car payment is the reason. So but so it's all an equation, and working with the loan officer to find out what that is, and what's the right way to go about it, is huge, before making those steps. So
and I think all the more reason it's I think people intuitively feel like, oh, they'll talk to someone like you when they're just like a few months away
When
from
they're ready
wanting
to put
buy,
the
when they're
offer
ready
in.
to put the offer
Sometimes,
in, they'll
yeah,
talk to you. Yeah,
yeah,
exactly. Yeah, sometimes not until like
yes,
after
that's
they've
right.
seen the perfect house,
Yes,
and then it's like, oh my gosh, it's like there's so much to catch up on. I genuinely wish that everybody would come and talk to me like 5 years before they decide to
yeah.
start shopping for
It's
a house.
never too early. That's a question I get all the time. Is it maybe it's too early, to talk. It's always just a conversation, and it's like we're here to help. That is what we love to do. That's what I love to do. I know you love to do it, and I think that's why we get along very well. We're very detailed in what we do, because it just makes our clients experience so much better.
We both like to teach. We both like hand holding someone, whether they've been through it never, first time, or if they've actually been through it many times. I sometimes lose sight. I feel like, once somebody has bought a house one time, they should know a bunch of stuff, but like realistically,
that is, yeah, I'm actually working
Yeah.
on one right now. They're actually downsizing from their house, and I get that all the time. Last time I bought my house, there was way less paperwork.
Yeah.
Why do I have to provide this or that? And so, the educating and hand holding is huge. The process is always changing. Requirements have changed, since a while ago. So, that's it's just great to be able to do that.
Exactly. So people need to have these conversations early and often to keep checking in,
often.
kind of be like, hey, you know what, we're thinking about getting a new promotion, or thinking versus like getting a new job and switching companies and stuff like that. What are the pros and cons of doing that if we want to buy a house next year, etc. These are the sorts of like big decisions that I think people have a tendency to, again, oversimplify and overgeneralize, because they don't realize, given their goal of home buying, they just have to have so much more like professional level of scrutiny on their financial decisions, and then I think, and I know that's hard, right? Like that's really hard. People feel very vulnerable about finances. I know I do, right? Like I don't love talking about finances, but it honestly, as soon as they meet someone like you that's really good at helping, really good at listening, it feels productive, it feels helpful. It doesn't feel like, I think people are scared that it'll feel like a job interview where they get rejected.
Sure.
Which maybe with a big bank it might be, but with a loan broker, it's your job is to kind of help them to build them up. You turn around, you present them to the banks and kind of help them to put their best foot forward with that.
Try to find the best way to proceed, and find the most value in that, and get them the right information. So much information available. You can look up so many things, but finding out what's actually right for you is huge, and there's no time too early to know that. So many times we'll set up a game plan, if it's credit, if it's saving, or many times I've had people that are well qualified but still just not ready yet. Finding out, wow, okay, there are property taxes, homeowners insurance, all these things. Okay, let's consider this and build our budget around that. And so that's one thing I love to do and help. Let's get you set up for that next step. First house, second house, investment property, whatever it is.
No, I've had people who, were looking at between houses and condos and townhomes, and they just didn't realize the impact that HOA fees have on how much they can afford.
And the buying and reselling of condos, anything with an HOA, when you're getting a loan, they're not just looking at your condo, like your specific condo, they're looking at the whole HOA, the whole condominium, the whole complex. As a whole. So if that HOA's budget is not where it needs to be, or if another unit has some repairs that are on a level that are deemed like unsafe or hazardous, that could affect the sale of your property there. So finding a good condominium with a good HOA that balances everything right is huge. That's definitely something to consider. You have your HOA payment, but there is more behind that. And a lot of people say HOAs, I don't want an HOA. I don't want that at all. But HOAs sometimes are excellent. just depending on where it is. So it's case to case, but what they do for that community, whether it's a condo or even a home that has an HOA, it could be very beneficial, keeping the property values going up because neighborhood just is nice and clean, it's maintained, and there are some benefits there too. So, yeah,
exactly. Yeah, the only run into problems if the HOA fees are too high, right? Because too high, and they generally over time will continue to go up because maintenance costs always increase as buildings get older. So too high, is bad because it inhibits the resale value later on. But when it's too low, that can also be a problem too, as you're implying. If there's a ton of deferred maintenance in the whole community, if their operating reserves keep going lower and lower each year, then it's just a ticking time bomb. Lenders can see it. Buyers down the road, may be able to see it depending on when you sell, and that can end up really destroying your long-term value as well. So all right, let's go on and talk a little bit about if there's any, I guess like a specific case study, like a specific situation. And I didn't really prep you for this exactly, but I just want to kind of really get into like a more specific situation where it's okay, like this person came in, I guess maybe with in some way kind of the wrong expectations, or maybe they weren't sure what they could do, and then it turns out that you were able to help. I was wondering if you can really just kind of pull up a very specific situation.
Yeah. I mean, there's so many of them. We run into them all the time. Very specific. Let's see. One thing that always comes to mind is, I've had it many times. Pretty similar scenario where I've had a client referred to me from a realtor partner or a past client where they were approved with a bank. So very specific one. This one's about a year and a half back. They were pre-approved with a local credit union for X amount of dollars, and they were referred over to me to just do a second opinion on the pre-approval. Whoever they want to choose is their choice. But when I pre-approved them, my pre-approval came back about $100,000 less than what they had from the credit union. So a lot of big banks, credit unions, they are very quick to issue out a pre-approval. Whatever you put in, they'll just go off of that and send out the letter. So for this client, I advise them, hey, we can get you an extra $50,000 on this. If we do, speaking of car payments, work on the car payment, bring this down here. We can go that route. Long story short with this one, or long story longer, they ended up putting an offer in on a certain house at that price point that the credit union pre-approved them on. And unfortunately it fell through. They came back to me. We started working on it. They got another offer in on a house. We got that extra $50,000 in approval to make it happen by working on their monthly debts to get them to a place to afford them that higher amount. And so that's one scenario where you will get different answers from different lenders. My pre-approval may be higher or lower. I've had many instances where I've been able to get a higher pre-approval by being strategic in either the loan program or working through their finances or credit score improvement, whatever.
No, I mean, it's I find that local credit unions are so hit or miss. I mean, some of them can be very good. Like certain unions, certain kind of professions just have very like schools first. I've always really liked the one for teachers.
Great for HELOCs really too. Yeah.
But when it comes to doing home loans, I mean, at this point, I used to think that there were still situations in which you might want to go with one of the big banks or even the online banks or stuff like that.
Oh yeah.
But man, the difference in service and the difference in I guess reliability of working with an independent loan broker, it's like a night and day difference.
For sure.
All right, thanks everybody for joining us today. Again, we are with Jonathan Williamson. This is one of my favorite loan brokers in the entire world. Jonathan, thanks so much for talking to us a little bit about your background, some of the interesting kind of ups and downs of the last few years,
Yes.
and I guess, some basically some general advice on, 2026 and onward. What are some of the things to watch out for? What are some of the strategies to watch out for? So, Jonathan, thank you so much for joining me today.
Richard, thanks for having me. You have a beautiful office here, and can't wait to come back. Thank you.
Awesome. Yes. Yeah. Let's do it again soon.
Let's do it again.
So again, my name is Richard Whalen, owner and broker of the Imagination Brokerage. You can find us at imaginationbroker.com.